All right, welcome back to the channel. Today we're going to be revisiting Arista Networks, ticker symbol ANET. And you know what? Let's just do the normal flow, starting off with a 5-year chart. We can see it's been up and to the right. We had a recent pullback from about 300 into the low 240s. And then they reported, about a week ago, something like that, a week or two ago, and they've been moving off of some good momentum off of that report, and they're back at about 319. My first video on YouTube for Arista, I think, was when they were around 160, somewhere in here, and I'll link to that video somewhere, and this is just going to kind of be an update. I'm not going to go too in depth. If you want to see the full video on Arista, you can go to that video. I think it's a little bit more in depth, at least hopefully. So let's go ahead and jump into their earnings report. So starting off with earnings whispers, we can see they beat on bottom and top line. Not only did they beat on bottom and top line, but they raised guidance. So when they reported at Q4, they had a pretty soft guide for 2024. They were guiding around 10 to 12% growth. And on this latest report, they revised their guidance on their top line growth for 2024 up to 12 to 14%. If you've been following Arista for any amount of time, you probably know that they don't usually raise guidance in Q1. They usually raise guidance or do any raising or lowering of guidance in Q2 as they have more visibility into the year. So for them to go ahead and raise right now, that's pretty like out of the norm for them. And the market obviously really liked that. They basically said that their three segments, enterprise, AI, and then their ISP segments are all performing better than they thought. So they felt comfortable giving, Q1, given the strong Q1, that they would go ahead and raise guidance for the 2024 fiscal year. So for Q1, they did see quarter-over-quarter growth, which is kind of surprising. A lot of times when you're in like tech fields, think of like Fortinet or Palo Alto. Usually there's like a large sales push at the end of the fiscal year to kind of cram in sales and meet your yearly numbers. And then you have kind of like this drop in Q1 going from Q4 to Q1. And they actually saw a 2% increase for Q1 compared to Q4 on a year-over-year basis. Q1 compared to 2023 and 2024 was a rise about 16.3%. So decent growth. And what we'll see is that if we break down into their 10Q, we kind of see where some of that growth is coming from. Product line, which is going to be kind of like hardware, is going to be the vast majority of the revenue, and that is still growing at a pretty decent clip, around 13%. But service revenue, which is like kind of support contracts and services that Arista provides to enterprises, is growing at a much faster pace now, and they're starting to see an acceleration in that. I think for Q1, it grew about 35% year over year, and it's starting to become a more significant part of their overall revenue stream. So the good thing about that is that the enterprise segment for Arista is going to be higher margin. So on their product line, for just selling their devices, they have about a 60% gross margin on their product line. On their services line, support contracts and whatnot, their gross margin is 80%. So got to keep that in mind when we're doing our evaluation. And, speaking of that, let's go ahead and just jump into the evaluation. So you can see currently that compared to the 5-year average, we're actually trading a pretty rich. 5-year average is about 3.36 yield multiple on net income, 3.72 on EBIT, 3.09 on free cash flow, and 3.19 on operating cash flow. And on an LTM basis, where we're at right now is 2.24, 2.59, 2.09, and 2.12. So we're kind of trading at that lower end, or I will say the higher multiple range for Arista compared to what it's historically traded at over the last 5-10 years. And you kind of see that they typically have been traded between this 2% to 4% yield. In 2019, they did briefly get into like a 5-6% yield and then quickly reverted back down. So they've kind of channeled between that 2 to 4% yield multiple for most of their trading over the last 10 years. All right, so getting into kind of the historical financials. This is just quarterly revenue graphed out, and it continues to go up and to the right. Yay, good. If you are interested in this, listen to their earnings call for the last 2, 3, 4 quarters, and then listen to Cisco's. it's a gem. It's a gem. Cisco. Cisco still is in a decline. They're still kind of like they're being devoured. So I'm pretty bearish on Cisco personally. I think it's cheap. It trades cheap for a reason. They're losing a lot of their core business. I think Arista is probably going to be the one that gets a lot of that core business over the coming years. But we can see, Arista has had very, very solid long-term steady growth. Their balance sheet, which is, EPS, gosh, come on. EPS growth is just insane. But anyway, their balance sheet, basically no debt, awesome position to be in, right? They've got $100 million in debt, and they've got over $5 billion of cash and short-term investments. So they're very, very well capitalized. They have tons of liquidity. They have tons of cash on hand for either buybacks or R&D or investment into plant equipment to ramp up production. So they're in a very, very strong position right now. Now let's go to free cash flow. Free cash flow is kind of ebbed and flowed. Once they got that second plant built for their product line, we saw a pretty drastic increase in free cash flow. So I expect that to kind of keep up. Let's go over to stock-based compensation is pretty reasonable in comparison to their free cash flow. You see that right here. Stock-based comp in comparison to free cash flow is not that bad at all. Ratios and metrics. Oh man. So this is where it gets interesting. Look at their profit margins. They've gone through really, really good multiple expansion, bottom line expansion over the last 10 years. And this is where, maybe that's going to stop, or maybe we're not going to see much more margin expansion in the next 5 years. But if their service revenue does start really taking up more and more of the overall revenue split, and that service revenue is at 80% and their other hardware revenue is at 60%, we might see an increase in gross margins that can potentially also lift bottom line margins even more. So that's something to kind of keep into consideration when you're doing the evaluation. And speaking of evaluation, let's go ahead and just jump into the template, and we'll see what I got. So for my kind of updated evaluation, we're gonna do this. We're gonna go for a 17.5% CAGR. Historically, their bottom line has grown about 24.94%. I think they're gonna have probably a moderation in top line growth eventually. They're getting to a pretty large scale, so it's going to be harder and harder to grow the top line at those type of numbers, but they have a lot of tailwinds from really two segments and specific segments that I think they could have a lot of tailwinds in. And that's the adoption of artificial intelligence clusters, the deployment of RDMA over converged Ethernet version 2, which that's a whole technical thing that we could get into a discussion on, and I'm not gonna do that here. But also, and this is something where I think people are distracted from the enterprise side of the business because of all the AI hype, and I'm really, really interested in enterprise. I'm possibly more interested in enterprise than I am in AI. If it goes as planned, which everything is pointing towards Ethernet being the preferred network infrastructure over even InfiniBand for these AI clusters. And you can go read meta engineering articles. You can go see the stats they've pushed or published between InfiniBand and Ethernet, and even the Arista commentary. On their last earnings call was basically that Meta was saying that their Ethernet clusters were performing functions and completing jobs about 10% quicker than their InfiniBand clusters. And Ethernet has the ability to scale horizontally much, much easier than InfiniBand. So it's open protocol. It's kind of like commoditized hardware, commoditized protocol. So I think a lot of the larger players are going to be pushing towards RDMA over converged Ethernet version 2 rather than InfiniBand. So the AI segment in general, I think we're going to have several phases. We're probably in phase 1.5 right now, or I think I can see probably another 2.5 phases I think phase 4, phase 2 to 4 is probably going to play out over like 5 years. But so anyway, lots of tailwinds. Everybody's focused on AI. Nobody's focused on enterprise, which I think is horrible because they're killing it in enterprise. They're starting to take more and more market share from Cisco, and enterprise has much better margins. So if they have much better margins, even though we might see top line contracting into a more steady growth rate of maybe like 10 to 15%, if a good number of that is coming from enterprise services with higher margins, we could see bottom line margin expansion, just from their enterprise business picking up a lot. And enterprise, if you don't know, they're going to be able to sell more services like customer support contracts, maybe engineering contracts, software as a service, different like Cloud Vision, different things that software-based services that they're releasing. While with like the Cloud Titans and AI clusters, those are most likely not going to be as service-oriented, and they're mostly just going to be hardware-oriented. So that's why I think the enterprise side kind of gets looked past, and I don't think it should. I think it's just as important, or if not more important, than the AI side. But anyway, I digress. So for this valuation, I've got their yield multiples going from a worst case in year 5 of 4.81 to a best case of 2.05. And that correlates pretty much with what we've seen in their bottom line multiples, yield multiples over the last 10 years. And then for their growth, I think they're probably going to do around 14 to 15% top line growth. Probably 14% top line growth average over the next 5 years, I think, is very achievable for them. And then we can probably add 1 to 2%, because I think we're going to get some margin expansion based off of a decent chunk of that revenue increase coming from enterprise. So I think we'll see even more expanding margins off of maybe a slightly lower top line growth. So top line growth over the next 5 years, I'm thinking around 14% or so. And then bottom line growth, I think we'll probably see about like 16%. So in the base case, I do have that 16% bottom line growth with in scenario 3, so about 15.96% bottom line growth with 3.18% yield multiple. And all of that kind of gets us to a point where right now, I've got fair value, I got fair value right around probably 230 to 300 or so, right around there. I think right now we're kind of stretched at the top end at fair value, because we are pricing in, the market seems to be pricing in a lot of tailwinds, and I think it's probably deservedly so that they are pricing in tailwinds. So under these assumptions, we basically have a 5-year target in basically the worst case scenario, which is like 10% bottom line growth, which would be that'd be bad, because they'd have to basically do 8% top line with a little bit of margin expansion to get 10% bottom line growth over the next 5 years. I don't see that happening. Scenario 1, 5-year price target would be 282. Scenario 2, 5-year price target would be 372. Scenario 3 would be 513. Scenario 4 would be 741. Scenario 5 would be 1125. And I kind of think we are probably going to land in between these two. Scenario 3 and scenario 4 is probably the most likely of where we land after that 5-year period. So I think they're going to have runway for, the AI runway could be for another 5, 6, 7 years. It's really going to depend on if we see a massive adoption of ROC v2, and then their enterprise runway could be another 3-5 years easily. It's hard to tell if we're going to run into a cyclical pullback in between some of these phases, but it's interesting, very, very interesting. So if we're going for a 17.5% yearly CAGR, scenario 1 by price would be 123, scenario 2 would be 162, scenario 3 would be 224, scenario 4 would be 324, scenario 5 would be 492. So we can kind of see that like we're probably priced in right now into this like scenario 4. The market's kind of pricing it in to this scenario 4 type of pricing multiple. Now, if we were going to do 15%, a 15% target KR, our scenario 3 buy price goes to about 255, which we were just there. We were about 240 a couple of weeks ago. Scenario 4 is 368, and scenario 5 is 559. Now, scenario 5 is really, really, really bullish. That's like very edge case. I really think we're going to land somewhere in between these scenario 3 and scenario 4. But yeah, that's what I got. I'm going to try to do more videos for you guys, maybe, as I have time. It's been crazy, but I hope everybody's been doing good. And yeah, we'll see you in the next one. As always, I am not a financial advisor, and none of this is financial advice. This is just my musings on another company and another potential valuation. So I hope you enjoyed it. If you did, please hit the like and subscribe button, and we'll see you in the next one.